Hello Internet, in this video we will going to talk about what the dual momentum is. So let's move on. Dual momentum strategy was created by Gary Antonacci, and his strategy became famous by his book with the same name, Dual Momentum Investing. His book is easy to understand and very well written. Here is the dual momentum in a few sentences. Look at the trailing 12-month return of US stocks and return of global stocks. If the US trend is positive, buy the whichever greater between the two, US stocks or global stocks. But if the US trend is negative, buy the bonds. Antonacci details more his strategy with the following sentences. Each month, calculate the total 12-month return of S&P 500, non-US stocks, and the bond market. If the bond has highest return, buy the bond for that month. Otherwise, buy the asset with the highest return. Repeat this process for every month. Let's talk about the details of dual momentum. Dual momentum is combination of two different momentum strategy. The book clarifies in details the difference between two types of momentum investing. First one is relative momentum, which is also known as relative strength. The strategy is basically compares the trend of an investment to another investment in order to pick which securities or asset class to invest. You select the asset or security that have outperformed in the present day and you wish that the outperformance will continue. In dual momentum, US stocks are relatively compared with international stocks. Second one is absolute momentum. The strategy is comparing an asset class with its own performance. Antonacci compares return of stocks over bond return in the last 12-month period to decide whether the absolute momentum is positive or negative. Antonacci unites two strategies into one system which is called dual momentum. The results in the book are quite promising with higher return, lower volatility and lower depression than the S&P 500. Let's talk about the results. This relatively simple strategy has performed unusually well over the last 20 years because it's so simple. The strategy is backtested and explored thanks to some researchers with data going back to 1998. Applying this strategy with a $1,000 initial investment in 1998 would have grown to over $42,000 by the end of the 2017. Whereas if it is invested in the S&P 500 in that time, it will become about $4,000. Overall, let's analyze its advantages and disadvantages. Advantages. First, performance results are encouraging and quite impressive. It promises large return. Second, management effort is minimum. The strategy is simple and it has only three options, which are S&P 500 fund, total international stock index fund, and the total bond market index fund. For example, during the backtesting, in 20 years it requires only 23 transactions. Third, cost is minimum. Due to its low activity strategy, it requires less transaction. Averagely speaking, the strategy only makes change once a year. As you all know, less activity in portfolio means less fees. Fourth, it is rule-based. It doesn't require elective or emotional decisions. It bases on two analytical comparisons. The relative momentum compares past 12 months return of US stocks between international stocks. The absolute momentum compares return of US stocks with T-bills. If the US stocks has higher return than both international stocks and the bond, choose US stocks. If international stocks have the higher return than the SP and bond, choose international stocks. If the return of bond higher than the stocks, choose the bond. Fifth, downside protection. If market becomes bear market, dual momentum preserve your gain instead of giving it back to market corrections. You can check performance detail during the bear market. Now let's move on to disadvantages. First, US stocks and international stocks are highly correlated. Analysis indicate that large US stocks are becoming drastically correlated with the international large stocks. That's why comparing these two may miss the trend. It is same also for the bonds. Bond funds contains a lot of corporate bonds which are correlated with its stock performance. So comparing with intermediate bond fund which doesn't swing as hard as corporate bonds may be more useful. Second, it is concentrated strategy. Only one asset class at a time may lead diversification problems. Third, it might not always work. There is no strategy that works all the time. After the 28 recession period, the strategy has underperformed the S&P 500 by a wide margin. But during the recession, dual momentum has actually done better than the S&P 500. Because this strategy performed better during the bear markets, but it doesn't guarantee to protect from any losses. Dual momentum is simply trend following strategy that never promises to get you right at the top, but it doesn't also get you right at the bottom. Side note here. Backtest only shows what has happened. It doesn't promise what will happen. This is true for all investment strategies. No one can be sure future of the markets. Lastly, when we compare dual momentum with value investing, in the value investing, buy at the discount and then wait. In momentum, buy the high and sell higher. Or alternatively, cut your losses and let your winners run. Value investing bases on the long-term gains. Dual momentum bases on gap in the time that creates gains. Value investing for the long term, whereas momentum investing is for the intermediate term. Momentum is hungry for performance with the taking advantages of performance chasers who are making emotional decisions. This is why it uses rule-based approach to avoid those emotions. In my opinion, both value investing and momentum investing can be used together, but this is for another video. So that's all for this video. I hope you enjoyed it. If you like this video, hit to the like button and subscribe to my channel. If you pick out any different point that I missed, please let me know about it and comment under this video to improve my future videos. I will see you in the next video. Thanks for watching.